Welcome to the SMB Options Tribe meeting for today, August 14th, 2018. So this week we have John Locke back on the Options Tribe for nearly countless times now, but on a very important topic and a very popular topic, and that is the M3, solving the puzzle of options income trading. If you all can stick around to the end, we'll have a couple of special offers with a very limited time period of availability. So we're going to be talking about that at the end of this as well, and I'll also be announcing next week's Options Tribe presenter. So now we will pass it over to the reason you've come, Mr. John Locke.
All right. Well, welcome everybody, and thank you for attending our special webinar today on the M3. And thank you, Andrew, for the introduction. Before we get going, just a little bit of what we're going to go over today. I have a couple of trade examples. You can feel free to ask some questions if you want. Andrew's going to be moderating. We'll answer them as they're relevant and as we have time. We don't have a whole lot of time, so but feel free to ask. And we'll see where we'll go. We'll get as far as we can through the two examples that I have, and we can do more examples if we have extra time, but I don't think that's probably going to be the case. For those of you who don't know me, as Andrew said, I'm John Locke. I'm a wealth and success coach. I specialize in trading performance and trading psychology. I'm with a company called Locking Your Success LLC. I train retail traders, myself and our coaches. We train retail traders, professional traders, hedge fund managers, and coaches and mentors from other companies as well. And we do that, so they can be the best they can be. I've also developed multiple trading strategies, as a lot of you may know. One of those strategies is known as the M3. Now, the M3 is what we refer to as a high probability market neutral positive theta trading strategy, which essentially means that the trade generates its profits over time rather than through price movement. And it's got a history of doing so quite well. So good, in fact, that we now have hundreds of people trading the M3 as a monthly income strategy. And, even though the M3 works great as a monthly income strategy, that was never the system's intent. The actual intent behind the M3 is to be a learning tool, a stepping stone, if you will, into the much more advanced and higher yielding ROC and M21 strategies. Now, people often ask me, they say, well, why did you build the M3 as a learning strategy rather than a trade? And the reason behind that is because there are plenty of strategies out there right now, and there have been in the past, that are capable of returning in the neighborhood of 20 to 30% per year on average on an account over long periods of time. There's really nothing special about that. But the reality is, if my only goal as a trader was to have a rule-based trade that returns, say, 20 to 30% per year on average, I could simply do a bull trade strategy, right? Our bull trade, if you're familiar with that, it's essentially a simple bullish vertical traded in a certain way. The bull trade is more simple. It's easier to follow. It's less subjective than pretty much any of the rule-based strategies you're going to hear about on the internet. And it rivals the performance of any of them. Now, to trade the bull, you don't need to know options theory. You don't need to know what the Greeks are. You don't even need analytical software. All you need to do is follow the rules. So if my ultimate goal was to simply show you a trade that averages 20 to 30% a year over the long term without adding any subjectivity, even knowing all I know about options and all I know about virtually every trade currently on the internet, even knowing all that, do you know what I would do? I'd do the bull trade. Now, personally, I'd add some subjectivity to that because I'm me, and that's what I like to do. But if I had, say, a friend, or I'm doing a wealth coaching client, or perhaps my daughter, for example, someone who wants to get as good or better returns in the S&P 500, or as good or better returns in many of the top mutual funds, but maybe they're not all that interested in actually becoming a real trader, I tell them to just do the bull trade. The bull's going to outperform most of the trades you see on the internet over time anyway. And that's why I never really considered the M3 as the end-all and be-all of a monthly income strategy, because I can get similar performance much more simply, spending a lot less time with fewer expenses than going through some of these more advanced stuff. So, that's that aspect. But if your goal is to be more than that, if your goal is to become more than, just trade by the rules and make a certain amount of money, if your goal is more than that, say to become maybe a confident options trader, for example, or something along those lines, then that's a very different story. Because while you might be able to make money trading the bull, you're simply not going to become a competent trader if all you're doing is following rules and hoping whatever you're doing works out. So if your aspiration is to develop into a trader, then the M3 should be part of your learning process, because the real intent behind the M3 is as a trader development system. And it's been proven time and time again to be very effective at doing that. In other words, if your goal is to eventually develop into a competent, high-yielding options trader, if you want to take it to the next level, then the M3 is really the way to go. If you look at our website, the Locking Your Success website, you'll see the M3 is only, we have this path basically for Russell or SPX, depending on how you want to go. The M3 is basically the beginning of a series of trades that are built on top of one another for the purpose of getting to the point of adding subjectivity to where you can trade the rock trade and even the M21 trade as a competent trader, because you really can't jump into one of those systems. You really need to take a progression, and the M3 is basically the first part of that. So that is the intent of the trade. Yet, even that being the case, the M3 continues to be a powerful core trading strategy among many, many retail and professional income traders. And even among the traders who've wandered to some of those other strategies, a vast majority eventually find themselves coming back to the M3 again and again as their core income strategy, because it's just that powerful and effective. So let me show you a couple of trades from this year. I have, and I didn't write down what they are, but I know what I want to show you here. The last two trades were July and August expiration. They were both profit targets, so I don't want to do both those trades. I'm going to do August, and I'll do something earlier, maybe a June. I think, if I remember right, June was a little bit challenging. But I'll show you the easy one first. August, 56 days to expiration. I'll kind of explain what's going on, and we'll go from there, okay? So basically, a setup for a classic M3 trade, as we call it, would be to do a 50-point wing butterfly with the short strikes about 20 points behind the current asset price. And generally, we're going to do 10 of them. And we're going to add a call in here, somewhere between 80 and 100 delta. Usually, we like to do 100. Now, we give you some flexibility within the program, because doing an 80 delta call or a 60 or 70 delta call is going to react differently under different conditions than doing, say, a 100 delta call. Recently, in the more upgrinding markets that we've had over the last 4 or 5 years, we're generally better off going deeper in the money for the most part. So what I'm generally going to do is I'm going to set up 10 butterflies. I'm going to see what my delta number is with the 10 butterflies. And then I'm going to add till I get around minus 90 delta or so. And then we're just going to add a call in here near 100 delta, or we generally go for as little time premium as possible, but we're in an environment now where time premium calls is a little bit high. But this is the setup here. This particular case, I'm running about minus 12 delta. Something this size would be what's known as a $50,000 position. You're going to start out somewhere between 25 and 35,000 usually, but it's a $50,000 position after adjustments. Possibly, we'll have to wait and see. But the concept here is to keep the T+0 line as flat as possible and to stay within about here. You see this range here, about 1650 to, let's see, about 1720 in this case. Keep the trade in that range in respect to where the tent is. Keep your T+0 line flat. Let theta do its work and make money over time. So that's essentially the concept behind the position. And as we're doing this, we're going to be making adjustments when things get out of whack, because as time goes by, that T+0 line shifts, the price shifts, and things change around. So I'm just going to kind of skip this forward. We'll talk about some of the adjustments you might make, and maybe some optional adjustments you might make that tend to be within the program. And the reason we have optional adjustments is because we want to let you experiment, whether it be in back testing or live trading with this. We want to let you experiment with this a little bit and get a feel what doing different types of adjustments do. So in other words, when we start to have a problem with a T+0 line, for example, there's going to be multiple ways that we can fix it. Each way you choose is going to react a little bit differently and going to be a bit more beneficial or less beneficial depending on the specific environment that you happen to be in. And those are the types of things that that we look at, in the M3 strategy. So let's just go forward here. This is going ahead 5 days. And we get in a situation where the asset price pulls down underneath our short strikes. Now, generally, if we get more than 10 points under the short strikes, we're generally going to move the tent. And we tend to be a little bit proactive to the downside because that's where a majority of our risk is. I mean, we might lose a trade to the upside. That is possible. But, you're not going to lose, if you're trading it properly, you're not going to lose 20% to the upside. You might take a bit of a loss there, but it shouldn't be anything like that if you're trading it properly. But to the downside, that's where all our risk is. So generally what we're going to do is we're going to take some action here. In this case here, I did a rollback to the trade. So what we're essentially doing here is when we do a roll back or a roll forward, we're essentially closing the position and we're reopening the position. So I'm going to come here, I close this out. Now there's certain ways to do this, right, that are actually within the M3 program and the incremental adjustability and stuff like that. We talk about how to adjust in a lot of the other bonus videos within the program, how to adjust this without actually pulling all the butterflies off, going 100 positive delta, and then trying to stick other butterflies back on, right? That's a learning event in itself, is trying to do that, because that would not be the proper way to do it. So you'd want to roll these, essentially roll these back. And in doing so, I'm going to reduce my size back down, because if I'm making a downside adjustment, I'm going to want to maintain my positive delta. I mean, I don't want to be positive 100 delta, but, maybe positive 20, which is about half of maximum. We allow positive 50 in this particular setup. So that being the case, I come in here, I do my rollback and maintain a little bit of positive delta. You can see, the T+0 line is still extremely flat. If I were to look at just the comparison on these, what we're doing is we're just moving the thing back. We're giving ourselves more room to the downside, and the more important part is you want to watch your reversal risk. Because what happens with the market, we say, well, when the market goes down, it's like pushing a basketball underwater, and when it reverses, it likes to reverse really hard. So, but the problem is we don't know where it's going to stop, right? So you want to maintain your positive delta on the way down for the most of the time. Occasionally we'll have a market crash, but we have to plan for the majority of the time. The majority of the time, we're going to go down. We're going to take a quick shot down. We're going to bounce like crazy. So then when we do this, we're generally going to maintain a positive delta on the pullback, and that's going to look like this. And let's just go forward here all the way to July 6th. That was, another 10 days or so, I think. And if we come here, we did get that. We got a hard market reversal, right? And we end up going back above the strikes. Now, generally, we do allow this to wander outside the tent. We do watch the Trade Vega to try to estimate the stability of the T+0 line. But generally, if we get 10 points, not 10 points over the long, to more accurately put it, would be 60 points over the primary short strikes in the position. If we get 60 points over the primary short strikes of the position, we're looking at a strong possibility of rolling this up. So so I can come in here and, at this point, take the position. And I'm just going to show you the T-log. I mean, not T-log, but the position. This is what we look like afterwards. So we're basically going to roll the position up, get more on top of the market, and come back to here. Again, anytime you do this, the primary concern being the T+0 line being relatively flat and controllable, if you can do that. There are times close to expiration where we'll let this sag, but generally this far from expiration, we are not going to do that. That's a pretty straightforward adjustment there. Let's move forward to July 23rd, right? So basically we sat there from the 6th to the 23rd. As time goes by, our expiration T+0 line heads more and more towards our expiration line, as we probably know this by now. And we're going to want to correct that. Now, there's multiple ways that you can correct this. Right. Also, we're trying to take some negative delta out of the trade, yes, but we're also should have some sort of other objective, and that's what's going to help you determine maybe which adjustment to make. Because how could we correct this? Well, we correct this doing this. Right. We can move short strikes, which is one of the more common ways to do it, and that's going to give us a position that looks like this. That'll straighten us out. We can, and this is going to give you a certain characteristic, right? There's going to be benefits to doing it this way. Generally, if the market's going to stall, if the market's going to maybe drift back a little bit, or it's not going to move a whole lot, generally that's a very good way to deal with that. The other way we could do this is we could roll back some of the upper longs. Again, all adjustments that are allowed within the program. That also cuts our delta number back, but it does something different, right? It still flattens the T+0 line if you superimpose them, but it pulls you further away from the tent. It drops your theta number down. It's going to be better to pull these upper longs back if we get a relatively large market move. It's going to be better to pull out the shorts if we get a relatively small market move, or particularly if we end up kind of up in this area here. So, you could, again, either one's in the program, and you could use the one depending on your thoughts on where the market might go. Now, you don't have to be right in your choice either, because realistically, you could make either move, and over time, if you do the same move consistently, you're going to make out fine. It's not really going to make a difference, but as you get to be a more subjective trader, you start understanding the market a little bit more, you can make choices like that. And here we just pulled back these 5 verticals. All right, and then going forward, I think that was it. Yeah, that was it. So we stayed in the trade a couple more days, and realistically, we could have done either adjustment. It would have resulted in the same thing. One may have resulted in getting out a day later or a day earlier, but this trade with a $50,000 planned capital has a profit target of 5,000, a maximum loss or an exit point of minus 5,000. And, we're over 5,000, so you'd actually pull this trade off at that point. So that is a simple trade that went well. They do not all go well, right? We do have some problematic trades. June is a little bit more problematic definitely a lot more problematic than August, but it still worked out okay. So let's take a look at that. I don't see any questions or anything yet. So let me move forward and go into something that is maybe a little bit more complex. So I'm going to go to, by the way, we do, for those of you who may not know, we do at Locking Your Success, not here at Options Tribe, at Locking Your Success, we do a Monday morning weekly update where we do track several of our trades. Some of them are SMB trades, some of them are not. And one of them is the M3, and we've been doing this we've been tracking it since 2011, or actually I think the M3 we've been doing since the program inception in 2012. And we do the real-time simulated trades. That's what this is here. It's a real-time simulated trade where we go in 56 days to expiration. We do the trades by the guidelines, and we go over what we did every single week, and we're doing them real-time. So we have to make decisions on gray areas or whatever decision point. We always have to make those in advance. And basically, I'll tell you what I'm going to do going forward. I'll tell you what we did in the past and how I think that the trade is going to work out in any given week. And that's a great benefit because you can kind of track what you're doing compared to what we're doing if you're in the program and get an idea of how things are going, okay, and how you're doing. So let's go to our June trade. And that starts on 4/20/18. Actually, I have a couple of questions, I think. My delta was plus 30 and Vega minus 2. Okay, these are on specific trade. Okay. With my delta, I was plus 30 and minus 272. Still at the end of the day, it shows a $265 loss in risk profile graph that is very weird. Okay, so it's just showing a position here. I'm tracking the Greeks on volatility smile approximation. So here's one of the things that everybody should understand about analytical software, and that is it's all different. So if you're looking at a Thinkorswim graph, or if you switch to Thinkorswim Smile, or if you or if you take your option view and you go from variable to EIOIO, or if you're on Option Explorer, they're all going to project different T+0 lines. You're going to have different Greeks. Therefore, that being the case, you are going to trade differently. So any given time, you may enter the trade differently, you may adjust the trade differently, and therefore when the trade's stressed, by that I mean is, if you get into an average trade where everything works out okay, then there's no problem. But when the trades start to get stressed, you can get very different results. And you need to be aware of that. This system was, so to answer your question, can I trade it with Toss Smile? Can I trade it with regular Toss? Can I trade it with anything? Can I trade it with, my, an astrological chart as to what the stars are doing at any given time? You could trade it, based on any of those things. The thing is, you're going to get different results, and this is not particular to the M3 trade. If you're doing any trade where you look at the profile of the T+0 line, or you look at the Greeks on the T+0 line, then you're going to get different results with the different analytical software. It's just a fact of life. So what you're going to want to do is you're going to want to go back test it in that analytical software to see what you're going to get. The thing with the Thinkorswim back stuff is you cannot back test, really, not effectively anyway, in that software. So realistically, you don't know what differences you're getting in the T+0 line profile and how they're affecting the trade. You simply don't know. I've seen a lot of people say that, it's Smile, so it's fine, and it's accurate, and that's not the case. Smile is sometimes better than EIOIO or regular. Sometimes it's not, right? And it's your job as a trader to kind of determine when that is. Again, this is about learning to trade versus following rules. All right, so those are very different. As far as your specific trade, I'd have to model it and see what's going on the position and whatever. But as far as does it work on Toss, I mean, it'll work on anything if you spread out the time. So my point being, whether you use any of those systems over long periods of time, you're going to do fine. Under specific periods of time, specifically short periods of time, you may see very different results from month to month. Okay. Can the M3 be implemented using IWM rather than Russell in order to learn? The answer is yes, and you're probably almost certainly going to be at a loss in profit and loss, because the reality is the commissions of in IWM as is associated with the actual trade size are so large that it's going to eat up a good part of your profit base, right? So we do have in the program, we do have a way to trade it with as little as $5,000. Right, so we can show you a Russell with one butterfly and mixing with IWM. We can show you a method to do that, and we also show you what we call an M3U, which is just a broken wing butterfly, and it's an M3 as a broken wing butterfly. It's one of the variations of the M3, or the M3 is a broken wing condor. That's another variation of the M3. We can have you trade that way, and that's a much more efficient way to trade. And realistically, that is the way to do it. Okay, if you're going to do that, is to stay in the Russell or mix with IWM, or just go into an M3U. All right, can you use on FANG stocks? Right, so you got to remember the answer is yes. You can use it on stocks. You can use it on futures and all that other stuff. Realizing that and again, this is the same with any broken wing butterfly style strategy that you might use on any of these assets. You need to realize that these suckers can maybe cut in half overnight, or double overnight, or move this extraordinary amount where you're just not going to see in an index. You might see the Russell 2000 move 40 points, maybe a little bit more. I mean, if you look back in all of history, that's all we've ever seen in a day period, right? From close to close. I think we may have one that was 60. You can go into, one of the FANG stocks and you might lose 300, $100, $200, $300 overnight. And my point being, you're taking on a very large risk. You really have to watch your position size, and you have to have that expectation as, hey, I might have 12, 13, 14 wins, and one of those could take that whole period away if something really weird happens to the marketplace. And again, that's generally going to be with stocks. You're not going to see with an index, because the index isn't going to drop that far. It's not even allowed to, right? You're going to have market shutdowns and all that. With the other things, you're not. Okay. All right, and how has the strategy performed this year relative to the bearish butterfly and the rock? It is performing better than the bearish butterfly this year. It is the rock trades 99.9% of the time. The rock trade strategy is going to be our highest returning strategy. Occasionally something else will beat it if you have a particularly bad year or something weird happens in the marketplace. 2016, I think, was one of those years. But this year, the rock strategy is clearly, by far, the best performing strategy of the year. All right. But again, this is part of the learning process to get up into the rock strategy, right? So very important to have this. So let's that's what we have. So thanks everybody for the questions. That was great. Let's how much time we have? Well, so we have another 20 minutes. So let's go in here. We'll take a look.
Yeah, we're doing great.
Okay, great, super. So I need to go to for 2018. For 2018. Okay, so here we have a similar thing. So one of the things about this strategy that's interesting, particularly if you use OptionView, which you really should be using, whether that's what it was developed in, and the OptionView variable strategy really is the best modeling software for the Russell, particularly when you get into broken wing butterflies or butterfly call type of stuff. So one of the things you should realize is that sometimes you come in 56 days to expiration and you have 10 butterflies, and that's too many. And realistically, you should be trading with 8 or 7, or you have to put verticals in to start the trade. And then you have other times where you might go 15, 20, 25 butterflies on entry. And you hear a lot about implied volatility skew from other people and so forth. And this is a way, and to me, it's a more effective way of looking at implied volatility skew than actually looking at the skew charts, because 99% of the people can look at a skew chart and they can say, oh yeah, it's curved or it's not curved or whatever, but they really don't have any way to associate that back to what it's doing to the position. Realistically, whenever that curve changes, your T+0 line profile changes. And depending on how you have to enter this position, and we kind of go into that when we start talking about entries, depending on how this, you have to enter the position, it basically tells you what your volatility skew curve is, right? So when we have to enter with like 15 butterflies, for example, with one call, I have a fairly flat IV skew curve relative to normal, right? And I can take that and I can associate that with what the market's actually doing. So, we're in a marketplace here that's generally uptrending at this point, right? We had that little blip in February and March, but you have this marketplace here that's just generally uptrending, and volatility should be low. I should be in 10 butterflies here to one call, not 15. Right, so it's unusual. What I'm saying is, so I can tell that there's some weird volatility shifting going on given the market environment, and I could also tell that then, and I can tell that today when we enter the trades today, we're even still flatter volatility skew than normal, at least in the Russell. So this is what we have. Anyway, I end up with 15 and 1, pretty much the same thing to start off. We can look at the price chart, I guess, if you want. Right, I guess we're a little sideways, but we've been uptrending here for a little while, right? Realistically, the volatility should have shifted down by now, but it hasn't. So anyway, and you can make whatever readings whatever meaning you want out of that, obviously, but which you'll do as you become more proficient in trading. You know, you'll look at these entries and you'll put some sort of a meaning on it. And you know, we're all a little bit different when we start being a little subjective, so we'll put different meanings on it. But anyway, you know, this goes by several days from. Actually, this is quite a while, isn't it? This is our first adjustment, and we've gone almost 20 days. We've gone about 18 days. Really, nothing's happened. The market's been sideways, and we're up about $1,300 because time has gone by and so forth. We end up being minus 113 delta. So we take a look at this. Again, there are multiple ways in which we could fix this, right? We can fix it by rolling in some upper longs, as we said before. And you know, let's just try to make this, let's just do 7. We'll try to make it about 50. No, maybe we got to do 10. Anyway, I can roll in some upper longs, and that brings me to about 50. If I analyze that, it looks like that. I can, you know, bring some of these up. That's probably going to take about this far. 10, 5. Oh, I don't know why it's giving me so much. I'm just trying to get close here. All right, so that's about minus 50. I could do that. I just want to analyze all these. This is just to talk about some things here that you should be recognizing as you're trading. Analyze that, or I can do something like you know, drop some butterflies out, all of which are allowed within the program, by the way. Right, so I could pull that down also. So if I superimpose these, I have basically 3 things that keep my T+0 line looking identical to me from, say, 1545 all the way up to, you know, 1635. So a very wide range. It keeps my T+0 line looking almost identical. But the reality is, if you experiment with these, you're going to find that each one of these adjustments is going to do something different when volatility shifts. They're each going to do something different when the market goes up or when the market goes down. And part of that is learning, you know, how positioning works and learning how to be a good trader. When you start to understand how each of these adjustments are going to affect what and what's going to be best in each individual situation. So that's all part of the process. In this particular example, what I ended up doing, and again, you can do the wrong one. You, in other words, or none of them are the wrong one, but you can do the non-optimal one and still work out okay. But the beauty of this is it allows you to do the wrong one, whatever turns out to be the wrong one, and still generally do okay. So I just pulled 5 butterflies off. I brought my delta down, you know, underneath normal. Maximum where this is now is about minus 50, and this is what the resulting position ended up like. So let me move forward here. Right, some more time goes by, and we get more than 60 over the lower short or the primary short, or 10 over where the normal upper long would be. Generally, we're going to do a roll up there. So, you know, we don't have a delta problem. We have a Vega problem. One of the parameters we like to use in this position is to keep your Vega negative. And part of that is because your T+0 line gets really unstable or unpredictable when you start getting into the positive delta range of the T+0 line. So, you know, that being the case, we're generally going to do something there anyway. But, you know, I've cleared the upside here, so I'm going to do an upside adjustment. When I do the upside adjustment, if I gone in with a symmetrical butterfly, I end up being, you know, minus 68 delta, which is basically probably towards the upper end of my limit. So I probably wouldn't want to do that. I'd probably want to come in, roll up, and flatten my T+0 line a bit. Something like that. So I got a nice flat T+0 line, which is within concept of the trade. And that's what we go up into, something like this. Okay. Moving forward here. I'm just going to move relatively quickly. If you have any questions, you can ask them. Actually, there's a couple in here, and we start running too high negative delta again at where it's positioned. I do another vertical, so I end up in basically a broken wing butterfly with a call at this point. That's what we look like there. Let me just address a couple of questions that came in here. What strategies work as a good hedge against the M3? And I don't like to think of working as a hedge against anything. We want a good hedge working with the M3, I guess, if you were going to do that. The reality is I don't like to hedge my positions. In other words, I put the trade on, I put them on appropriately sized, and I trade them out. Whatever happens, happens. I've been trading that way since 2006, 2007. We talked to hedge fund managers. There are a lot of different ways you can add different hedging depending on which direction you want to hedge it in, and what kind of move you're trying to protect against. Now, the fallacy in trading is that you're going to protect against all moves, and no matter what happens, you're not going to lose a whole bunch of money. And that is a bunch of crap. And realistically, the sooner you can get that out of your mind, the sooner you're actually going to become decent at trading. And go ahead and go in there. Now, you never want to take on excessive risk within your positions. And if you're in an M3 strategy or a broken wing butterfly or any strategy, and you start taking on too much directional risk, where it's just, in other words, you don't want to be taking on losses that are substantially bigger than your average gains. Then you may either get out of the market, you may close this trade, go into something that's further from expiration, or you can add put protection, or you can do your ratio spread, or whatever you want to do to the position to add it in there. As far as hedging it all the time, realistically, grow up and be a man or a woman, and deal with it. You're going to lose a little while, and I say that with love, right? I really, love traders. I love to see them do well. I love to see them do, fantastically. But the biggest challenge that I see with people in not making a substantial amount of money in the market is that they simply are afraid to take losses, or they're resistant to taking losses. Trading is a gamble. I don't care if you're doing, the super high probability thing where you win 99% of the time, or if you're taking, long shots doing straddles or out of the money calls. It's a gamble. It's all a matter of putting, where do you want to put the odds in your favor? At some point, you get to the point where you're working your ass off in trading, trying to keep your T+0 line straight, getting all these crazy positions, and you go through 5 years of trading and you average, 1% a month, 2% a month, or you're break even, or you're down money, right? And it's like, why are you even bothering? Right? Go out and get, unless you got like $1 gazillion and making 2% a month means something to you, and you have good entertainment value in doing so, why are you going to waste your time? I can come in here and I can do a bull vertical, and you know what? I'm going to have down moves. I'm going to lose some money. I'm going to have bad years like 2008. I'm going to lose some money. But if I take that and I do that every year for the last 20 years, I just follow the rules, I'm averaging 20 to 40% a year. A year like last year, I make 60% in the marketplace. If you're over hedging your positions, you are never, ever going to do that. It's just not going to happen because you're so afraid of losing money. You're simply not making anything, right? I do have traders that trade that way, and I respect them and so forth. But realistically, if you really want to make some money, you need to you need to get away from this over hedging thing. It's really going to be problematic for you longer term. Okay. So just a comment. Right. Casino owners don't get upset when a table has some losses. They know over time they win big. Right. So, and you need to think that way if you're actually going to make it worthwhile. Like I said, if you have some sort of entertainment value, from putting on a bunch of trades, and you don't really care if you make any money, but you just don't want to lose, then yeah, go for it. But that's not the way I trade. I can point you to some traders who trade that way. Anyway, let's see. Another question here. Will the M3 require big changes when we enter a prolonged bear market? Well, you see, that is the great thing about the M3 strategy in general, right? We've live traded this from 2007. Not just myself, but a lot of different traders. I mean, we didn't have that many trading them back in 2007. I had a few one-on-one clients. That was the extent of our business here because I was kind of new at trading myself. But we've traded this through 2007, 2008. We've traded it up through the 2009 rallies. We've been through the 2010 flash crash, all with live positions. 2011 crash with live positions. 2013. We haven't always been, in other words, we had our rocky times in the process, but over the long periods of time, we've always done extremely well. And in fact, we've actually did extremely well in 2008. One of the things we need to look at too with some of these strategies, which I was talking to someone the other day, is that we haven't seen all kinds of markets since 2008. Somebody was talking to me about I deal with a lot of traders who don't trade my strategies and might trade something else. And I was dealing with a trade that he was talking about, and he looked at it 2008, said, well, see, this thing handles a bear market. And I said, well, no, that's not true. 2008 really wasn't a bear market. And you might say, what are you, out of your mind? And I say, well, no, I agree with you that the price went down and the index cut in half. But realistically, that was a 6-month period. So what that was basically a free fall with very volatile back and forth down movements for a period of about 6 months, and then the market took off to the upside. So to me, that's not necessarily a bear market. A bear market is like 2000 to 2003, if I'm calling my time frames right, or maybe 1999 to 2003, where you have this gradual crushing of the asset price over a very long period of time. So you might have some trades that reacted very well in 2008 that are going to get crushed in an actual secular bear market, because realistically we haven't seen that. We saw another crash in 2010, lasted like a month and a half. We saw a 3-month, maybe a 2-month incident in 2011. Right? Anything that happened in 2015, 2016, very short-lived. So most of you have never actually been through a bear market. Heck, I've never actually been through a bear market because I've never been in that environment, but I know that it exists, right? And I can make an estimation of how it would do. Now, this M3 should do fantastic in that secular bear market because of the way it's set up. Realistically, and I know it did okay in 2008. So those markets are pretty much covered. We know we had a little bit of trouble first half of 2013. We had some trouble first half of 2017. Other than 2016 was also a little bit problematic, but 2017 happened to be the best year we've ever had in the strategy. So we've been trading this from asset price from around 350 on the Russell to asset price over 16,000, almost 17,000. And we've traded it through almost all of the market conditions that we've had, other than that secular bear market, which I don't think is going to be necessarily a problem. So we should be able to do that. Given that you're going to have periods of time, so a couple of months, 3 months, 6 months, where things might be a little bit problematic, generally it pulls out. Right? Well, it always has pulled out, right, historically. So, this year, for example, February was problematic. Now, February wasn't problematic because earlier this year wasn't problematic because of a down move, right? So that's the other thing you need to look at when you're looking at your strategies. People will say, well, the market went down, it had a problem, therefore it's bad to the downside. No, that may not be the case at all, right? 2007, earlier this year, we had a volatility event. We had volatility skew shifts in the market like we've never seen before, We had weird profiles. We had, strange movements in volatility as it relates to price movement. All those things were very unusual. And that being the case, when you have very unusual volatility movement, your results are going to be different with the same price movement. So you got to remember, you're trading volatility almost more than you're trading price movement. And I can get a 100-point move, down move in the M3, or even you go on the Russell, say 2008, we have maybe 200-300-point down move in the Russell over a period of a week, and have no problem with an M3 trade. And then you can get a situation back in February where you have a relatively small down move. I don't know. It was maybe 100 points, and you get slammed. Right. That's all a condition of the volatility shifts. And this is what we're trying to teach you in the program: is that it makes a difference. What volatility is doing makes a difference without addressing it specifically. We address it specifically in some of our other programs, but without addressing it specifically, just showing you through trading and back testing that it makes a big difference in things. All right. Could it be a sole bread and butter strategy? Yes. Keeping in mind, actually, hold on a second. Let me answer a question before that. The M3 is a long hedge trade with a butterfly. Is there some point, depending on the market movements, that long bias could be morphed into a short trade? Yeah. I mean, you can, right, the way the M3 program is set up, we don't take anything into market consideration. I mean, we don't take any market considerations into anything. We show you the trade setup, and we should give you a set of guidelines to go by. We give you some options on how to accomplish our goals, but we don't take any market bias into consideration. I can take, if I want to take market bias into consideration, I mean, there's a gazillion different things I can do, but it's not an M3 trade anymore necessarily, right? It's an options position, but that's the point of the M3 positioning or the M3 trade, is that if you do want to add bias, you have a somewhat of an understanding of what each type of an adjustment does, or each type of a configuration does. And if you can do that, if you can have some sort of an information, a bias of what each type of a configuration does, then you can make your own modifications to it, right? Because in order to properly set up for a bias, you have to know what you're doing. We do M21 trade, right? An M21 position is where we come in and we do this analysis on the market, and we make expectations of where price movement is likely to be. We set up a high probability strategy that's built around whatever our biases happen to be at the moment. Sometimes we have no biases and we'll enter an M3, and that'll be our M21 strategy for the month. Other times we might get into something a little more aggressive. We might enter something negative theta. But it's going to depend on what's going on. Now, one of the challenges with this strategy is I can tell someone, I can give them the price market, I can give them the market movement. I can say, I'll tell you what, you look at the chart, you know what it's going to do over the next 30 or 40 days, you know what it's going to do in the future. I want you to design a trade that's going to make money, the most amount of money in that environment. And they design this trade, and then they trade it through BackTrader, and they lose. And that is because they didn't understand their positioning, right? They thought they understood what the position would do and how it would react under those price movement conditions, but they really never understood it. So one of the exercises we do is design the trade, the price movement, until you get to the point where you can design trades where you maximize price movement. So the question you're asking is kind of along that lines. Yeah, I mean, if you have some sort of a bias, then by all means, you can, and you want to play it, by all means, you can come in and you can do that, right? You can play it. But what a challenge a lot of people have is they play the bias, but they don't play it properly. In other words, they do something and it's not right. And part of what I would like to think, at least, that trading in M3 does, if you're actually paying attention to what's going on and not just trying to follow guidelines, you kind of pick up on that, and you end up being a lot better at estimating what the position is actually going to do if the market does what you think it's going to do. And of course, that always flows back into the trading itself and understanding your position when you're in, just go by the rules again. So could the M3 work as a sole bread and butter strategy? This is highly situational dependent, right? Because I'm not just trying to teach you a trade, right? And I'm not trying to teach you the best trade or necessarily or whatever. I'm a wealth and success coach for people. So, in that process, we talk about people's net worth. We talk about, their goals going in the future and where to position their income and so forth. So if you're asking me, do I take 100% of my net worth and do I throw it into an M3 trade? And the answer is absolutely not. Right? This is not what you should be doing from a wealth standpoint. I mean, certainly it's possible to do it, and you'll probably do okay. But realistically, that is not the way you should be doing it. I mean, you need to have, we have multiple income streams and all this other stuff going on. But as far as part of your the part of your investment portfolio that you put into options, can you make that your sole bread and butter strategy? And the answer is yes, you absolutely can. Keeping in mind that needs to be put up against, what your net worth is, what your trading experience level is, and all that other type of stuff. Okay, so you always have to keep that in mind. All right, so. All right, so let's go forward. I have another quick question, and then, we're probably not going to get through this example, but that's okay because you guys are asking questions, and hopefully I'm answering them for you. So do I use the true delta, true theta model? Yes. Can you comment on your use of combining the call skew check mark for the combined skew thingy? And that's Dave, my neighbor from New Hampshire. Yeah, so this is what I try to do with the model. So one of the things that we need to understand as traders, all of us, is that this model that we have, the analytical model, in this case OptionView, is just a model. And it has a whole bunch of different settings that you can use. No matter what you use, it's certainly not going to be 100% accurate, and sometimes it's not really even close. It's just a gross estimation of what the software developer thinks is going to happen to the volatility of the market when the price moves. That's all that is. And you can alter his expectations by changing the model. So one of the things we do with the M3, and I mean, some people don't realize this, and I'm just going to throw this out there. This M3 thing that I put together in like 2007. I didn't have OptionView. I didn't have back testing. I wasn't even that experienced trading, but I knew how things did. In other words, this was developed through hitting the market hard, learning, hitting the market hard, learning, lots of trial and error type of a thing. And then when it came to, say, 2010 or so, we already had one-on-one. I had a lot of one-on-one clients trading like this. I had some hedge fund clients trading like this. I traded like this somewhat because I generally I'm looking for more return than what an M3 is going to give me. But I traded like this somewhat. And when we made the program, we essentially backwards engineered a set of guidelines that fell in line with what I was doing. Right, so rather than going in and back testing something a million years and tweaking it, back testing it, tweaking it, and form fitting it to the market, basically I said, well, this is what I'm doing. Let's develop a set of rules around it, and so that we can make it easier for other people to duplicate that. And that's the way we did it. And when we did that, I'm looking at the software models, and I'm saying, well, what model, what do I have to do to this model? Because OptionView has a whole bunch of settings. What do I have to do to this model in order to get it to work the most close or to get it to be most representative of what's actually happening when the price moves back and forth, right, or whatever. And those settings happen to be, if you come in here, using the Yates, true delta gamma, combined put call skews with the variable model and the 10-bit ask, right? Because this makes a difference as well. And the other thing that makes a difference in OptionView is your define level, right? If you're defining different levels in large, then you get different things. If you're defining 5-point strikes, only or 25-point strikes only, you also get slightly different readings. This was the most representative T+0 line of what actually happened on average, right? Because we have different conditions. I can pick any one specific condition and say, well, this model was better or that model was better. But on average, that happens to be the model that most reflected where the T+0 line most closely reflected what was going to go on when the price moved at different volatility levels and so forth in the marketplace. So that's what we that's what we use. And that's in the Russell 2000 index. That doesn't necessarily go over to the SPX index. You go over to the SPX, they have a different volatility skew profile, and that volatility skew profile reacts differently. So while I might use the variable in here with combined put-call skews, that's what gives me the most accurate reading here. If I go over to the SPX, that's not the case. I don't have to, but it's more beneficial generally for me to switch to some other model, which we could go over at another time. So there is a difference in the asset as well and how you want to do it. The most important thing is that you learn how to read the analytical graph and understand under what conditions it tends to be right, under what conditions it tends to be wrong, and then you can go there and make adaptations. You don't have to do that to be successful trading the M3. You can just go by the rules as they're written down. But as you get more as a subjective trader and so forth, and you're trying to estimate things and get an idea what's going on, then you could change settings depending on certain conditions. Right. So it's not necessary, but it can be. So, that's the M3. We didn't get to go through this one, but essentially what happened is we had a crazy up move and we ended up, making $1,000 or something here. But that's essentially how the trade works. Now, I'm just going to quickly, actually, we have to get going because we're about out of time, but just a little bit of background on the system. It was initially released in 2011. But it was developed in 2007. I initially developed it as a tool to get people to understand options trading better. So the trade was developed over 10 years ago. It's been live traded since 2007 by somebody, including me, pretty much constantly through the 2008 market crash, through the rallies of 13 and in 2009, flash crash 2011. Our most profitable year ever recorded in the M3 was actually 2017. So my point being, the system's been proven time and time again in live trading over the last 10 years, making the M3 the most enduring, the most proven trading strategy in live market conditions that's available anywhere. Add that to the fact that we see a lot of good results in transforming people into extremely skilled options traders. And, it makes me more excited about the M3 than I was even 10 years ago when it came in, and that says a lot. So I'm just going to quickly show you a couple things that are in the program. I'll hand this over to Andrew, right? We've had multiple additions to the program since it was introduced in 2012. So initially it was introduced as a classic M3, with multiple adjustment strategies, when to best utilize those strategies, and a detailed examples with a 4-part video series. Later on, we had some questions on entries and adjustments, so we added an entry and adjustment strategy. We had concerns with people with smaller accounts. They didn't really understand how to take the content in the video and apply it to a small account. So we added an incremental adjustability and capital control video, which goes over M3U positions, which is the early M3U, trading small positions and managing the capital in the trade, which is a great addition. We did a video specifically on entries for the M3. We did a 2016 program update, which was a very significant update. The M3 can be traded within multiple variations. We have an M3U and M3E, which is a capital efficient M3 for people looking for higher returns. We have a long-term M3 for people who like to trade further from expiration, and all kinds of things like that. And that is included in the 16 program update. And then we have a Kickstarter mentoring program. It's a 3-part video series that is essentially intended to get people up and going as quickly as possible within the program. And then, of course, we have our question and answer bonus video from our last year's promotion. So, and we're going to be doing another video, I think, this year for the people who own the system. So that's all I have, Andrew, and I think we have questions. So I'm going to kind of hand this over to you, if that's okay.
All right. Yep. Sounds good.
All right.
And I will tell you all right now about the upcoming M3 event.
And you may want to share your screen at some point here, too.
Yeah. All right. I'm remoted into another computer, so I just got confused about which computer I was operating. There we go.
Well, that's easy to do.
Yeah. All right, there we go. All right, so let's get back up here. And I can tell you about the upcoming event, but first is our special offer with a limited time. So for 2 weeks, we're going to do this. 2 weeks only. We are marking down the M3 options trading system course. We still have it labeled as the trading system because that's what it's affectionately known as, but maybe we'll actually update it to be the trader development system. But it's $14.75 is the regular price that we have throughout the year. And for 2 weeks only, we're running a special offer. You can get it for $12.49. Additionally, everybody who owns the M3, so even if you bought it 5 years ago, you may attend on Friday, October 12th, the special Q&A with John Locke. And that is a web meeting that we turn things around, and instead of just being a lecture or presentation, we make sure that we cover every last little question that you have about the strategy. We do this typically around a time where we run an offer, because then there's usually a lot of new M3 traders showing up. So that gives you the opportunity to take the course in the next several weeks. If you were to take advantage of this offer, take the course, start trading it, start understanding it, really spend time with it. And then around the middle of October, we get together and have a Q&A on it, make sure we cover everything. Basically like a free group mentoring session. It's very valuable. 2 ways to get to it. Easiest, fastest is m3options.com. Is a URL that will take you to the information about the page, or you can go to optionstribe.com and navigate to that as well. Also on optionstribe.com, you can join the recording of this session and all of our weekly webinars and John's SMB Monday update are available in the archive going back. I always lose count now, but it's, I want to say 6. That probably means we're 7 years into this. So we're several years into this of weekly meetings. This picture is actually old now. I feel like we keep updating it and it keeps getting older. So 350 hours of Options Tribe education and webinars about various topics. So optionstribe.com is a place to do that. You can learn about the Options Foundation program. If you are new to options trading, there's also mentoring programs as well. A new one I'm going to tell you about in just a moment. Developing strategy. So if things John was talking about today were a little over your head and you're not quite sure what a butterfly plus a call or some of these adjustments are, some of the more basic strategies are listed on the screen for you. You can learn all about those at optionstribe.com. And then intermediate strategies listed here. M3 coming in at the top is probably one of the, or if not the most popular in that list. I'm just going to, it's the most popular. If not just for a duration, but
it's been around a long time, and we've had a lot of successful people there. So
that's right, and it is the a lot of success, a lot of fans, and a lot of people that have traded it for 5+ years. Because a lot of times you find people who have been trading it 6 months and you wonder where everybody else is, but trading it year after year, big community of those. So, and it is the prerequisite for some of the more advanced strategies listed on the screen here. A new, one of these is not new, but one is new, is the workshop. So that's a systems trading workshop. So options systems. We get into a lot of futures options and signalized options trading and backtesting and group backtesting and group workshop environment. That's here at smbu.com/workshop. The new thing is that the lower half of this slide is you can do a first hour of mentoring with SMB, and that session will be with me at this time. Seth also does an offer occasionally throughout the year. Right now, that session is with me, and you can do a discounted first hour where we would spend time getting to know your background, your experience, and then my goal is to give you a strategy for developing as an options trader, and that may mean pointing you toward a specific strategy to focus on, or a certain type of mentoring, or certain software, or certain things to work on. So either way, that is something for you to look at. The link isn't the easiest to get to, so I just put my email address in there. That's probably the easiest way to get started on that. So that's an old picture. And here it is. This is next week's Options Tribe meeting, Tuesday, August 21st. Ophir Gottlieb, sorry if I said that wrong, with Capital Market Laboratories, identifying the impact of stock gaps and the timing of directional and non-directional options strategies to play volatility and momentum. Almost ran out of room for that one. So cool topic there. Stock gaps, directional and non-directional option strategies to play volatility and momentum. So very cool. Looks like getting into individual equities there. So that should be very interesting as well. I'm not Seth Freudberg, but I play Seth Freudberg on Tuesdays when he's on vacation. So this is his email as well, if you'd like to send an email out, but he is currently on vacation. But either way, I thank you all for attending. I thank you, John, for your excellent presentation. Someday we'll count up how many of these you've done and start sharing that with people, because it's, if anybody's wondering, it takes a lot of work and time and effort to put these presentations together, and we appreciate that every time you come, you share valuable information with all of us.
Thank you. And thanks everybody for joining us. We really appreciate it and supporting us, and happy trading.
All right. Have a great rest of your week, everyone, and we'll talk to you soon.
Thanks, everyone. Good night.